Hi guys, and welcome to another edition of The Pursuit of Moneyness. My name is Marnus Mostert, and I'll be taking you through this episode where we will be discussing the 10 best money commandments that you can do with your finances whilst you're in your 20s. But for those of you older than that, in your 30s, 40s and onwards, I won't be leaving you in the dark. Look out for some more videos coming in the next couple of weeks where I'll be discussing the same money commandments when you're in your 30s, 40s, 50s and 60s and onwards. But before further ado, let's jump into this video where we will be discussing once again what you should be doing with your money whilst you're in your 20s. Welcome back, guys, and just before we get into this, I understand that the generation, as they call it, the millennials, being in their 20s, I understand the need for instant gratification. I also understand that you want to enjoy and live life for the now, the right here. In other words, traveling will take priority over retirement savings, which kind of makes sense. But what if there was a way that I can tell you that you can still combine the two into one another, so you can still meet your obligations, but at the same time live for the right now and live in the moment type of thing, if you can do it correctly. And I think the problem with the generation is not that they want this instant gratification type of lifestyle. It's merely a fact that I don't think they understand how to combine being financially savvy with that. So hopefully this 10 commandments will bring you some clarity as to what you can possibly follow, but that it can also transpire into you living in the now and traveling and doing all the things you want to do with your money at this present point in time, whilst you can enjoy it. So without further ado, let's jump into it. Our first commandment is something that you'll have to do it. It's a bit boring and you're not going to want to hear this, but you'll just have to unfortunately do it. And that is income protection. So guys, what is income protection in a nutshell? If you're 20 years old, you still have about 540 paychecks until retirement. Guys, that's 16,200 days. That's a lot of probability that something can happen, whether it be sickness or disablement, that prohibits you from earning your income. So what income protection essentially does is if something like a worst case scenario had to happen and something prohibits you from earning your income, income protection will kick in. So in layman's terms, you earn 15,000 Rand a month as we're sitting here right now, but you're expecting increases each and every year. But now something happens to you in 2020, you can't return to work, you can't earn your income anymore, but you're still very much alive and with us. Income protection will kick in, pay you your 15,000 Rand each and every month as you go along. It will also supply you with yearly increases each and every year. Why do you need that? Well, once again, 16,200 days worth of living and then you only retire. In other words, with the income protection, you can still pay your medical aid. You can still pay your retirement annuity in order to one day retire. Because remember, you won't be able to work anymore to supplement that need of retirement. So that's why it's there. Essentially, what you're doing is you are protecting your future financial earning potential, if I can put it like that. So you basically ensuring those 540 paychecks to ensure nothing happens to them, or that there's no interruption of you earning the 540 paychecks. So once again, guys, I know it's not exciting, but it's one of those have to do steps for every 20-year-old, because protecting your income is as good as earning it, unfortunately. Commandment number 2, guys, once again, not the most attractive thing, but this will help you get that financial savvy balance versus what you want in the now. And that's basically budgeting. So my recommendation would be to either use the My360 app from Standard Bank or 22/7 from Old Mutual. Both of them actually extract your bank statement so they can see exactly where your spending is going. And that's exactly what you need. You'll have graphs of that. You'll have detailed information broken down in different categories. But also another nice thing is if you do have debt or investments, they can basically take all of those accounts into account, calculate your net worth, show you your interest rates on basically what you've earned in your investments as well as the debt you have. But it's vitally important that you start off with a budget, factoring in variables as well, But the most important factor why you need to have that is to actually find this balance that I speak of. Basically saving, investing, having insurance, but also going overseas and having a holiday, enjoying the finer things in life. But there should be a balance, and none should take priority over the other, if that makes sense. And the only way that you can construct a plan in order to have this balance is unfortunately by having a budget. But those two recommendations I made to you makes it very, very easy to actually follow a budget and understand what's happening in your budget. Money commandment number 3 is avoiding bad debt. Now, just a disclaimer and a personal opinion from my side, there's no such thing as good debt. There's this ongoing battle between good and bad debt, which I don't believe in, and I'll tell you why. I just categorize it as bad debt and even worse debt. I see my salary. If I pay off my mortgage and I pay off my vehicle loan and credit cards and all that, and my entire full salary comes into the house, I see that as a powerful financial weapon that I can now use to basically build my wealth via investment, to start a side hustle because I've got the means to do that now. And alternatively, I'll go on an overseas holiday, or I'll basically find every instant gratification categorized need that I could possibly think of and satisfy that instant gratification need. The thing is, if you've got debt, it's like an anchor keeping you down, in my opinion. But there is, a difference between the bad debt and the even worse. So to categorize the even worse debt, that's things like personal loans, credit cards, and clothing accounts. Guys, avoid it at all costs. Why should you avoid it? Well, reason number 1, you're putting your future self, your 30, 40, 50-year-old self under pressure. The reason why you're putting yourself under pressure is because those accounts are commonly linked with interest rates well above 20%. So you're paying an institution 20% more each and every year than what you should. But if we're sitting here and you are in debt and you've got vehicle debt, you've got a mortgage loan, and you've got some credit card debt and a personal loan, for example, it's tough to try and find a strategy to stick to. So how am I going to pay it off faster? Where do I start? Do I start with the smallest debt or the debt with the biggest interest rate? Guys, watch this video where I discuss the debt snowball effect. I always recommend it. It's the one that I use in my personal capacity. It works. Okay, commandment number 4 is basically looking after your credit score. Now, once again, in the PDF is a detailed explanation on how you can actually achieve that. But let me get to the reason why. Guys, in your lifetime as a 20-year-old, you're going to be applying for finance. That's going to be applying for finance for houses, vehicles, etc. The banks look at your credit score, your credit rating, in other words, to see that are you eligible for the loan in the first place. And now if you do get the loan, what interest rate are they going to charge you against that loan? So it brings me back to my previous point. Guys, look after your credit score. There's a full research explanation on how you should be doing that. But at the end of the day, trust me, this small detail will help you get lower interest rates, meaning you're spending less on your debt. It'll also make you more eligible for bigger loans such as housing loans. The problem is, if you're not going to get full 100% loans, you'll need to come up with the capital. So if a bank gives you a 70% loan, the 30% you'll have to come up with, and how are you supposed to do that? So look after your credit score, pay your bills on time. Commandment number 5 is building an emergency fund. Now guys, please don't underestimate the importance of building an emergency fund. You've got a 45-year career ahead of you. I promise you, it's more than likely that you're probably going to be retrenched or fall ill or whatever the case may be, and you'll need to fall back on some sort of a safe haven, which is the emergency fund. There's a lot of risk that you take when you apply for different debts and start businesses and doing all those type of things on your family if you don't have an emergency fund. The coronavirus pandemic is proof of that. People close their businesses after 2-3 weeks of being closed. Why? Because they don't have an emergency fund. Now, if you're wondering where do you need to save that, how much you need to save, rule of thumb is 3 to 6 months. That's first of all where I will start. But second of all, if you do have a home loan and you're lucky enough to have an access facility, an access bond, as they say, try and save the money there, because not only will you be saving on interest for the bond, but the money will lie there readily accessible to you in case of an emergency. Okay guys, commandment number 6 is retirement funding. Now, before you put the phone down thinking I just wasted your entire afternoon, wait. There's 2 main reasons why I want a 20-something-year-old to start investing in retirement. Reason number 1 is for the compounding effect, compound interest, described as the 8th world wonder in the world by Albert Einstein. It's as true as they come. If the earlier you start, the better you'll be off in your life. And that's very, very true. Go and look at this video where I fully explain the effect of compound interest. And just by saving 5 years later, what massive effect that has on your future self. Essentially, the earlier you start, the less you have to contribute later on in life. And later on in life, when you need to contribute more, your circumstances might not allow you to contribute more. So even starting with something small has a massive domino or ripple effect into the future. That's reason number 1. Reason number 2, the tax man gives you money back if you invest into retirement. Now, the point of this is not to get too technical. I've covered it in other videos. It's also in the PDF. But up to 27.5% of tax you paid them, you can actually get back from them as call it a reward for investing in retirement. Now, this is where we jump back to what I've been saying in the video, whereby finances doesn't have to be boring. You can still kill 2 birds with just 1 stone. What do I mean by that? On the one hand, you can strengthen your retirement and build your wealth, as well as save tax on a yearly basis because you're investing into retirement. On the other hand, SARS gives you money back in return for all those savings that you've given yourself, in other words, but they give you money back. What can you now do with that money that you just received back? Now, this is where it gets interesting. This is not my advice. This is just an option for you as a 20-year-old to make retirement savings more attractive. You can now take the money that SARS gives you back and you can basically go and spend it on an overseas holiday. Commandment number 7 actually relates to commandment number 6. Because this is where I call it the pay yourself first commandment. So it's actually as easy as setting up automatic debit orders each and every month as you get your salary that goes towards wealth building tools. This could be savings, this could be your side hustle, this could be saving for retirement, investing for a medium to a long term, whatever the case may be. If you're going to first get your money and then make financial decisions, you're probably not going to make them. So this is a way of forcing yourself, but I tend to see it as paying yourself first. So once again, this is setting up automatic debit orders that go off as soon as you get your salary, going into something that builds your wealth at the end of the day. Commandment number 8 is starting a side hustle. In other words, guys, opening up a business. Now, a lot of people think, but it takes money to make money. That's bull twang. You're just 2 steps ahead of where you need to start if you need enough money. The thing is, if you've got a marketable skill or a learned skill, consider being a consultant part-time. Obviously, your employer needs to know about this arrangement, but the point is, if you've already got a certain skill that people want, that people need, consider doing it in the evenings or over the weekends. Even if you earn 15 or 20% of your current salary, trust me guys, this will be an amazing wealth building block into your future. Let me give you an example. You can think of it, take it close to home and think about your own certain circumstances. But for example, I'm obviously trained in financial matters. I'm a financial advisor by trade. So I decided to open up a financial channel, a money channel, advising a broad-based audience instead of just sitting in my office waiting for people to come there and advise them there. Now I can teach and talk about something that I'm passionate about, but I've also got the skills and the knowledge to back that up. Hence being this podcast and a money channel whereby you can learn personal tips and tricks about your personal finance. Guys, it's as easy as that. That's my side hustle right there. Number 9, guys, and this is not to blow my own horn, but this is very important. From a young age, you should partner with an independent financial advisor. So 2 things. What is an independent advisor and why do I say that? So an independent financial advisor is somebody that's not limited in basically giving you only one company's product. Why? Because all different companies cater for different segments in the market. There's certain companies that only cater for professionals. There's certain companies with rewards programs, which doesn't make sense to somebody that's 70 years old to be going to gym each and every single day. It might just be the end of them. So there's different companies, there's different needs. Each and every family and individual has different needs. Try and find an independent financial advisor that can link your unique needs to a unique product offering from these various product providers. But that's not the main reason. So the second reason is why you need that building relation, why you need to build a trusting relationship with a financial advisor is quite simply, guys. If you're in your 20s, you might start to look at having kids or getting married or buying a house, buying vehicles. It's all over the place. I mean, now you need to, when do you need a will? It's things like that. So it's easier to have a go-to person that you can contact and say, hey Marnus, listen here, I've just bought my first property, or I'm looking to buy my first property. What knowledge can you share with me on buying my first property? It's as simple as that, guys. But if you don't have a connection with that person, and what I mean by connection, it's not when the person comes to see you every odd year just to increase your policies. That's not what I mean by a connection. A connection is when you allow the person to look after every financial decision that you take. Call it a financial mentor. My last and final commandment number 10. This is the self commandment, if I can put it like that. This is where you look at yourself. This is where you build your own brand. And this is not a self-help type of video on how to do that. But guys, it's as simple as updating your CV regularly. It's going on to LinkedIn and keeping your LinkedIn profile professional but also active, sharing things that's happening in your industry. Especially if you start a side hustle, people want to see you busy engaging. They want to see and feel that you love what you do, otherwise they won't buy from you. So doesn't matter what occupation you're involved in, build your own personal brand, but also don't burn your bridges as you go from one company to another. Keep positive relationships going. Build other relationships. You'll never know when you need to fall back on those relationships. In closing, I just want to say that in your 20s, it's probably going to be the most confusing financial time and period you're going to experience. But the ironic part of that is it's the most important part. It's the part where you either can jeopardize the future you or grow the future you significantly. And it's a matter of deciding which way you're going to go with this. Either way is very easy with the correct help and the correct guidelines in order for you to make those financially savvy decisions. Therefore, my suggestion would be for every 20-year-old watching this or other people willing to share this to 20-year-olds is really to partner up with somebody that's got your back with every single financial decision. If you've got a financial advisor, you should never ever take a decision without that person. They should be a financial coach in your life. So my suggestion is partner with me in the sense that I want you to share, challenge me, ask me questions, share future ideas that I can perhaps make videos on. But most importantly, I think the mailing list is roughly at 1,000 people that's already on my mailer list that gives these type of tips and tricks on a weekly basis. So if you want to join the mailer list, kindly send me your email address. How can you do that? You can email me on this email address. Alternatively, there's a WhatsApp button that you can actually just click on and it will take you directly to my personal cell phone number, whereby you can send me your details and for us to engage with one another and see if the personal tricks and tips and tricks that I teach can actually be valuable in your personal circumstances.